What boards are asking about energy and environmental risk? Recent governance surveys from NACD and PwC show climate and environmental risk consistently ranking among top enterprise threats, but the more telling shift is qualitative. Directors report asking more financially specific questions. Insurance repricing, interconnection delays, regulatory exposure, and supply chain carbon requirements are now entering board packets, not as narrative updates, but as operating constraints. The conversation has moved from values to viability. Board oversight is evolving accordingly. Can our growth plans actually be powered? Electricity demand in the United States is projected to rise through 2027, according to the U.S. Energy Information Administration, EIA, reversing years of flat growth. At the same time, the Federal Energy Regulatory Commission, FERC, reports continued backlogs in interconnection queues, with thousands of gigawatts of generation capacity awaiting approval nationwide. In many regions, projects face multi-year delays before grid connection. Boards are beginning to ask a more pointed question. If expansion plans assume energy availability, what happens if capacity cannot be secured on schedule? For large energy-intensive operations, electricity is no longer a background assumption. It is becoming a gating variable. Delays in grid access can defer revenue recognition, inflate capital carrying costs, and strain investor expectations. What happens if insurance becomes the first stress signal? Insurance markets are already sending financial signals. Global insured losses from natural catastrophes have trended upward over the past decade, with Munich Re and Swiss Re reporting sustained billion-dollar events at increased frequency. NOAA data show a growing number of U.S. weather and climate disasters exceeding $1 billion annually. Commercial property premiums in high-risk regions have risen sharply, according to Marsh's Global Insurance Market Report, with some industrial policyholders facing significant rate increases or coverage narrowing. Boards are no longer asking whether facilities are exposed to extreme events. They are asking whether chronic exposure, heat, wildfire proximity, flood risk, will structurally increase operating costs through insurance repricing. Insurance has become an early warning mechanism for physical climate exposure. If underwriters reprice or withdraw capacity, the financial consequences are immediate. Are disclosure obligations turning into liability exposure? Regulatory frameworks are hardening. The SEC's climate disclosure rulemaking process, even amid litigation and political shifts, has elevated board accountability for climate-related risk oversight. In Europe, the Corporate Sustainability Reporting Directive, CSRD, significantly expands reporting scope and audit rigor for companies operating in or exporting to EU markets. Meanwhile, enforcement posture remains uneven but consequential. Even as regulatory priorities shift at the federal level in 2026, state attorneys general and regional regulators continue to pursue air, water, and hazardous substance cases, creating financial exposure through penalties, remediation orders, and long-term compliance obligations. Boards are increasingly asking whether environmental disclosure is aligned with operational reality. Inconsistent reporting, incomplete risk mapping, or insufficient internal controls can create exposure beyond compliance costs, particularly if investors perceive misrepresentation. The question is no longer, are we compliant? But, are we defensible? How exposed are we to Scope 3 and supply chain carbon pressure? Procurement dynamics are shifting rapidly. CDP's supply chain reporting indicates that large buyers are increasingly requesting emissions data from suppliers. Many multinational firms now incorporate carbon intensity or sustainability criteria into procurement contracts. For industrial suppliers, failure to meet customer sustainability requirements can mean lost contracts or pricing pressure. Boards are beginning to ask whether Scope 3 exposure is being modeled as margin risk rather than reporting burden. If customers embed emissions thresholds into purchasing decisions, carbon intensity becomes a commercial variable. This shifts sustainability from narrative reporting to revenue protection. Are we modeling physical risk as acute events or chronic degradation? Physical climate exposure is often discussed in terms of extreme events. Yet chronic stressors, rising average temperatures, water scarcity, repeated minor flooding, can erode asset productivity over time. Studies from reinsurers and risk analytics firms indicate increasing asset exposure to heat and flood risk across commercial real estate portfolios. In some regions, operational downtime and maintenance costs are climbing incrementally rather than catastrophically. Boards are increasingly asking whether facility risk models account for long-term productivity degradation. If assets require more cooling, more maintenance, or more downtime over a decade, the cumulative financial effect can be material. Chronic stress rarely produces headlines. It produces creeping OPEX. Is sustainability performance affecting cost of capital? Sustainability-linked financing mechanisms are expanding globally. Bonds and credit facilities tied to emissions or environmental performance can carry step-up provisions if targets are missed. Credit rating agencies, including Moody's and S&P, have integrated environmental exposure into sector risk commentary, particularly for utilities, heavy industry, and infrastructure operators. Boards are now asking whether environmental performance is influencing borrowing costs, insurance terms, or investor engagement. Even modest basis point adjustments can compound over large capital programs. The implication is structural. Environmental exposure is increasingly financial exposure. A governance shift, not a trend cycle. The emerging pattern across boardrooms is not ideological. It is structural. Energy availability, insurance repricing, regulatory disclosure, supply chain carbon, and chronic physical risk all intersect with earnings predictability. Governance surveys suggest directors are spending more time on risk oversight. But the more consequential shift is qualitative. Environmental exposure is being interrogated with the same rigor once reserved for liquidity, leverage, and market volatility. The framing has changed. Boards are no longer asking whether sustainability is aligned with corporate values. They are asking whether energy and environmental exposure are embedded in financial modeling, capital allocation, and strategic timing. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.